Ladies and gentlemen, time for our final panel discussion for the day, but a very significant one. And this is going to talk about what flexi-cap and multi-cap investing, actually how it becomes reliable and what makes flexi-cap and multi-cap investing reliable and does it fit with today's markets. So that is the theme for the session. And we have some very, very eminent panelists with us to deliberate on this theme. Now, I'm personally very excited for this session, ladies and gentlemen, because we all want to know what makes flexi-cap and multi-cap investing reliable. So, of course, the lineup of panelists is as exciting as it can be. Mr. Sandeep Bansal, he's with us here today. He's the senior portfolio manager at ASK Investment Managers, and he has a work experience of over 20 years with over 16 years in equity markets. Mr. Bansal joined ASK from SBI Life Insurance, where he has been an equity fund manager and was head of investment research, leading research across asset classes. Also, Mr. Bansal has worked on the sell side with UBS Securities and Kotak Institutional Equities. Before that, he was a business consultant at KPMG and also has banking experience with Citibank. Mr. Sandeep Bansal is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad, and he joined ASK in July 2021. We have with us Mr. Govind Agrawal, Director of Alpha Accurate Advisors. He's an FCA and a graduate in law. He has over 2 decades of experience in the Indian capital markets. Prior to joining Alpha Accurate Advisors, he has held key positions with several reputed organizations such as Reliance Capital Asset Management, UBS Securities, Motilal Oswal Securities, and he played an instrumental role in setting up the macroeconomic desk at Reliance AMC. Before this, Mr. Agrawal has worked with UBS Securities India Private Limited as an executive director, where he spearheaded India accounts for large FIIs. Also, Mr. Agrawal's decade as a senior vice president at Motilal Oswal Securities Limited helped him specialize in advising major institutional domestic and foreign investors on sectoral allocation and stock selection. Our other eminent panelist is Mr. Abhisar Jain, who is the head and fund manager of Monarch AIF and has 14 years of experience in equity markets with specialization in equity research and niche in identifying high quality businesses. Mr. Jain has recently been awarded the prestigious 40 Under 40 Alternative Investment Professionals in India 2022 award by Equalify. He also has the distinction of a special recognition for best stock ideas received from multiple fund houses like HDFC Mutual Fund, ICICI Pru Mutual Fund, and Aditya Birla Mutual Fund. And ladies and gentlemen, those are our eminent panelists. This session will be moderated by Mr. Archan Thakur, who's the Chief of Business Development, Private Wealth and Banks at Motilal Oswal AMC, and brings over a decade of overall experience and currently Chief Business Development, Private Wealth and Banks at Motilal Oswal Asset Management. Prior to this, Mr. Thakur was head products at Abacus Asset and also had stints at Mirai Asset, Reliance Nippon Life Asset Management, as well as Barclays. We're so privileged to have all of you. And thank you, Mr. Thakur, for agreeing to moderate this session. It is now over to you. Please take it away.
Thank you so much, Aishwarya. Good afternoon, everyone, and thank you for joining this discussion. Most important part of investing is obviously asset allocation, and we can build it through diversifying across various funds. There are so many types of funds, mutual funds, regulation sort of categorized in, let's say, flexi caps, multi caps, mid caps, small caps, etc. In alternates, however, you can obviously have flexi caps, you have thematics, you have broader market focused funds. So we have our panelists today, and we'll discuss with them how to choose and whether to position in flexi cap strategies or dedicated mid cap, small cap strategies, thematic approaches, how risk reward should be thought in these spaces, how earnings are shaping up in across market caps as we speak. And obviously, we'll also take this opportunity to get some themes forward-looking from them from a medium-term perspective. So quickly, let's set the context and get views from all the three panelists on the topic. And then basically, we'll try to get into more specifics on how to navigate these strategies going forward. So with this, let's say we can start with Abhisar. What's your views on the topic?
Yeah, thank you, Archan, and thanks to PMS AIF World for inviting me for this event. Archan, I think the flexi cap funds have their own unique place, I think, in the overall equity space when allocating money. And the good thing about the flexi cap space is that it can adjust the weights in the portfolio according to the situation of the market. Because as we know, the pure small and mid cap funds need a longer term horizon, because they generally end up fluctuating from extreme optimism to extreme pessimism. Okay. And in those scenarios, generally the portfolios can become a little bit more risky. So from that perspective, I think the flexi cap fund gives the fund manager and the asset manager the flexibility to kind of move their weights between the mid cap, large cap, and small cap spaces. And with the market increasing in depth, it gives them more flexibility and the more options. So I think we generally at our AMC have been always more inclined towards running flexi cap schemes because of this flexibility that we have. But in general, I think the flexi cap category is sort of an evergreen category. Okay, it will always stay relevant, even if the market is at 22,000 Nifty, or even if it is a place where, say, the small cap were too depressed just 2.5-3 years back. At that time also, you could have a slightly higher weight in the flexi cap scheme towards the mid caps and the small caps, and you could benefit. At the same time, you can reduce the risk in scenarios like today, where supposedly the mid caps and the small caps are running a little bit at elevated valuations. So yeah, Archan, this is what we feel about this category. We feel that it is always going to stay very, very relevant. And it is one of the evergreen categories where you can do multiple things, but more importantly, you can balance the portfolio from a risk reward perspective.
Sure. Thanks, Abhisar. Govindji, if you want to take the sort of next brief on the topic.
Sure. So first of all, thank you, PMS and AIF World, and thank you, Archan, for having me here. So taking it forward, what Abhisar has said, clearly it is an evergreen portfolio strategy, whether it is from the wealth advisor's point of view or investor's point of view. Now, Archan, you started this with categorization for mutual funds different and for the PMS or alternate investments funds different. So the regulator has clearly defined in case of multi-cap. And there are also clear definition for small cap and mid caps. But for flexi cap, there is no, if you see internal segmental limits, that means the mind of the regulator and what is normally understood in the market among the advisors as well as investor, that is closer to multi-cap. It is not mid and small cap kind of thing. So it is very important for any wealth advisor and investor, in case they are looking for PMS or AIF schemes for the investment, it's important to look at the internal limits, whether the scheme has specified those limits or not. Because what happens if it is, say, someone, you have a PMS scheme which is termed as flexi cap because there are no internal limits. Now, if someone is having 80% into mid and small cap, and there's a other PMS scheme which is 50% mid and small cap, we clearly can understand the risk which is associated with mid and small cap more, right? So to my mind, what we believe that the flexi cap, as Abhisar said, and it is widely understood, it gives the flexibility to the portfolio manager to tweak the allocation based on the market scenarios, to tweak the allocation based on the opportunities which are available, and it is also termed as a dynamic allocations. Right? If that be so, I think it's very, very important to understand that while it is seen as a flexi cap scheme or multi-cap scheme, the weightages should not be tilted towards mid and small cap. Now, to give you example, what we follow, we have a flagship scheme called India Opportunity Plan, PMS. It is a 14-year-old plan. This is true multi-cap. Here we have defined that minimum 40% will be in large cap. Because we all understand that large caps, are relatively, less risky. They fall less in the times when the markets, collapse, right? While small cap and mid caps fall much more. while we have another scheme where one can term this as a flexi scheme, 85% is mid and small cap. Now, from that perspective, both are flexi cap. But would you call that 85% mid and small cap as flexi cap? Answer is no. And then you look at the, as you said, the second part of your question, what is the risk reward? So clearly we can understand the risk in case where the allocation to small mid caps is higher, risk is clearly higher. Obviously the returns are higher, but that too again in the short term. Let me give you some data points. Now, as on March 2023, 31st March 2023, if you look at the, the performance of mid and small cap, and Nifty. So Nifty was up 11% and mid and small cap were 9% around, right? So they slightly underperformed. This is just say 1 year back. Fast forward 31st January 2024. Nifty is up 16% while mid and small cap are at 25, 28%, right? So this has all happened in 1 year time. So which has skewed the performance on 1, 2, 3, 5 year basis. But if you look at on say 12, 14 year basis, the performance evens out and they perform in line with this. So coming back to this, while flexi cap is definitely is the strategy and one should look at, but it is very important that the investors and the advisors look at the internal allocations and if the portfolio manager is taking undue risk, I think the investor and the advisor need to take a call whether to exit that strategy or or they are comfortable with higher allocation to mid and small. As Abhisar said that the valuations are elevated, and I would say that they are a lot elevated at current levels and risk has significantly increased, and there's a lot more retail participation which is happening there. So from that perspective, if you ask people, everyone is saying be very cautious in mid and small cap. But I mean, that is the segment which is performing. And let me give you one bit more data point. October 2021, the Nifty peaked out. October 2021, after that COVID rally. And it bottomed out in June 2022. But the mid and small, and it fell around 15-16%. Nifty fell 15-16%. But mid and small cap fell 25%. Right? So this will lead to the higher volatility in the performance where the schemes are more skewed towards the mid and small cap. So summarizing this, clearly one needs to understand the allocation to various segments.
So thanks, Govindji. You sort of expanded on this topic very well. Sandeep, any views on the topic in brief, and then we can get into specific? Sandeep, you're on mute.
Yeah, thanks a lot, PMS AIF World, for the opportunity. Thanks, Archan. So, I completely agree with Abhisar and Govind. And just to add to their points, I think the flexi-cap strategy kind of offers a more comprehensive opportunity basket to the fund manager to participate in sectors and avenues which might not be available in specific market caps. So just to take an example, let's say the relatively younger sectors or newer sectors might not have achieved that large market cap size, which would enable a large cap dedicated fund to participate in them. So let's take the example of maybe banking or to that extent insurance, wherein a greater set of opportunities could be available in the large cap space, which maybe a mid cap or a small cap dedicated fund might not be able to participate in. Similarly, let's say some of the newer age opportunities, whether it be in the world of internet first businesses, or maybe in travel and tourism, or maybe even to that extent in capital goods, the names that could be available would be more of small cap and mid cap in size rather than large cap. So to that extent, the flexi cap strategy enables the fund manager to allocate capital to whichever sector he or she believes has greater growth potential versus the risk that they are taking. So, I would agree that, flexi cap is in that sense is a better way to play the markets. At ASK, most of our funds, are flexi cap strategies.
Thanks, Sandeep. And we'll touch upon this topic that you mentioned, that a lot of the new themes that are in the market today are not there in the index. Govindji, you mentioned about a lot of the funds being either predominantly large cap biased or going to the other extent and being predominantly mid small caps. How would your thought process be? Is agility practical in some of these spaces? Does fund size constrain? And how should investors look at flexibility of moving across all these market caps?
Very good question, Archan. So I see there are three parts to this question. One is the agility you said. Second is the large cap and small mid cap, and how should one investor look at it, right? So the very fact the name itself provides the agility to the fund managers, right? The flexi cap. As Sandeep also mentioned, Abhisar mentioned, it is the discretion given to any fund manager basis the opportunities in the market. For example, we were in our flagship scheme IOP India Opportunity Plan. Our construct is around 50% large cap and 45 to 50% mid and small cap, and this has always been there for last 14 years, right? Now, what we did recently, when we are seeing that the small mid-cap valuations have gone up and the margin of safety has reduced there, we increase allocation to large caps to nearly 60%. This is just a month back kind of thing, and reduce exposure there. So that is the kind of flexibility it offers. And based on, because what we are seeing, risk in small mid-caps have increased kind of thing, right? Now, the moment we see that, and relatively, if you see the large caps are, many of them are available, say 3-year low valuations or 5-year low valuation and quite cheap, and this higher allocation to large cap also protects the downside kind of thing, right? So that is the kind of agility and dynamism this flexibility provides to the fund manager. But as I mentioned at the beginning, that a fund manager should not take this to extreme. Even Sandeep mentioned that, it is not that extreme. Okay, because I'm seeing that opportunity, let me take it to 75, 80%, and because of which the performance get bloated or very high performance. But as we all know, and I gave the data point, over say 10 to 15 years period, they all even out and they gave similar returns, right? So it's very difficult to time from that perspective that I will be able to do it well across the cycles. So from that perspective, agility and allocation to say various segments. Now, if you can repeat the third part, how do the last part of the question?
So is it practical to be agile? So, you can move from 20% large caps to 80% large caps. Is agility to move restricted by fund sizes? What is your view on that?
Yeah, fund size, correct. Yeah. See, while it is very...
You can have flexi cap funds, but does it actually move that much?
While it is very much possible, let me give you one data points. In case of mutual fund, while it is not available publicly for PMS and AIF alternate space, but for mutual fund, this is available. Now, if you look at the flexi cap schemes of mutual fund schemes, where the AUM is 30, 40, 50,000 crore rupees, the large cap allocation is 60, 70, 75%. Right? So fund size restricts them for allocation into small and mid cap and even smaller mid caps, which may call it as a micro cap, because 50,000 crore rupees, even if the fund manager decides a 1% allocation, that means 500 crore rupees of buying, right? And the floating stock may not warrant that kind of allocation. And because of this compulsion, he or she has to move up the ladder in terms of average weighted market cap. While in case of PMS and AIF, generally, if you see the AUMs are less, 5,000 crores or 10,000 crores or 10, 15,000 crores, it gives them a lot more agility to go lower in terms of market cap. That's the advantage PMS and AIF offers. And as Sandeep mentioned, because of this smaller size and the agility, we are able to capture many new themes, which may not be possible for the larger fund sizes, So that advantage clearly we have from that perspective. And not only this, based on what is your investment philosophy, if you are able to, maybe, there are cases where a theme is beginning to take place. Like, for example, capital goods. We started playing this 3.5 years back in a big way, and we increased the allocation to capital goods around 10%. Prior to that, we played a specialty chemical, which we were very early, China plus one strategy, and our allocation was almost 10%. And because of the agility, we have the space now in specialty chemical, we are practically zero because we are seeing that opportunity. We played it well. Now that opportunity is not available and we do not know how long this will be available. So that kind of the flexibility and agility is very much possible in case of, say, PMS AIF, and also because of smaller sizes.
Thanks for that. Sandeep, you mentioned that a lot of the new themes that are emerging are not there in the index, right? So how would you define your style of investing? You focus on quality is what I believe. Whether you would have a different definition of quality across these market caps?
So that's a great question, Archan. So, for our philosophy, quality we believe is market cap independent. The way we define quality is, broadly speaking, high return on capital, a very large, impregnable kind of a moat of business, sustainability and visibility of growth, predictability, durability, and consistency of earnings. Uh, these characteristics could be available in business of any size. It is not necessary that a large-sized business has to be necessarily of good quality, and it does not, concomitantly, it does not necessarily mean that a small-sized business will not be of good quality. Given these inherent characteristics and given the way we define quality, uh, and given our relatively longer term time horizon of investment and our bottom up approach, we are relatively market cap agnostic in our investing style. So for us, market cap is not an input criteria at the time of decision making. We believe that if a business inherently has the characteristics of quality, growth, good management, large size of opportunity, and the margin of safety that we are looking at, uh, then we would go ahead and invest in them. And market cap is ultimately going to be an outcome. Having said this, yes, it is true that the evidence of quality could perhaps be present in a larger proportion in relatively larger sized businesses because of the fact that they've been in existence for a longer time period and they have weathered downturns, which is a very good demonstration of their inherent quality and strength. So the proportion of, let's say, higher quality businesses could be relatively more in large caps versus, let's say, small caps and mid caps. Yeah, so that would be my answer. But in our approach, for us, quality is market cap independent.
Thanks, Sandeep. Abhisar, question to you. 2003-07, we had broad-based earnings. Obviously, then we were hit by the global financial crisis. Then almost a decade where every year we started the year with expectations of 15% growth, ended with 5%. We had the currency crisis, we had COVID, we had IL&FS, we had GST, DeMon, etc. And finally, over the last 3-4 years, again, we have broad-based earnings growth across market caps. We have seen a similar move in the markets as well. And markets have been kind to almost all investors. Whether you see, all the three pockets still attractive or anything specific that you like amongst the three?
Yeah, Archan. So, very true. See, the good thing is that this market rally has been driven by, you know, a lot in terms of the earnings growth, also living up to the expectation or being ahead of the expectations. So, like you mentioned that, every year we had started with higher Bloomberg consensus EPS, and invariably the Nifty EPS would get cut. Arjun, this year for FY24, we may have started at 940, 950 kind of EPS for Nifty, and we are hopefully going to close at maybe 975, 980. So the EPS has got little bit revised upwards. FY25 EPS, most participants now see it between 1080 to 1100 odd, which at, just 9 months back or 6 months back or 12 months back was at least 5 to 7% lower for FY25. So in that sense, yes. But having said that, if Nifty is at 22,000, we are at 20 times of that FY25 EPS already. And in many, many segments, we are well above 20x. Maybe we are at 30x, 40x also. So as such, what we are seeing is that at this point of time, the value is definitely from a risk reward perspective, more in a lot of large cap segments. But because as I think Sandeep mentioned, and also what Govind was saying, that the newer segments have been coming into the market and getting listed in the last 3 to 5 years. So for example, let me just give you an example. If 10, 12 years back, if you had to play a real estate cycle, and like the way the real estate cycle is going very strong, much stronger than everybody's expectation, 15 years back, 12 years back, you had to play a real estate developer to ride the cycle. Today you have 5 subsectors to play that cycle. You can pick something in wood panel, you can pick something in plastic pipes, you can pick something in ceramic or tiles, you can even pick a mattress player, and you have the wire and cable player. So I think while large caps have a lot of value at this point of time in terms of risk reward, but we are also seeing some of these sub segments within mid and small caps which may have value. Okay, so continuing on that example, like some of the ceramic or the tile players, the biggest tile player, is he maybe has been going through time correction for the last 2 to 3 years because gas prices were very elevated, the exports of the tiles were little restricted. So there might be a value here, and the real estate cycle is looking, to be lasting longer. So it's a case to case basis. In my view, we are cautious on mid and small caps from a general euphoria perspective, that all of them are obviously not having value and some of them are very, very elevated in valuation. But we do find certain pockets like these, certain pockets like road construction and private players in the road segment on the mid and small cap side look very, very interesting. Considering what KKR has been saying and doing also. They have recently bought a asset from a private road player at 1.7 times price to book, which is a 2,900 crore transaction, by the way. So I think, it's like finding value in the right pockets in mid and small caps, and generally being a little bit more constructive on the large caps at this point of time because of risk reward.
Thanks, Abhisar, for that. Sandeep, question for you. There are always medium-term themes that we can target, right? Alternates provide a way to target such themes rather than have just one-size-fit-all kind of a positioning. So what would be your view on some of the new themes from the next few years perspective, and whether valuations are also appropriate to enter those themes at this moment?
Sure. So, Archan, as we've been experiencing very good growth for the last few years, the set of opportunities that are available for investments are increasing as economy itself is broadening. So there are actually multiple themes that are interesting, emerging, and we believe will continue to emerge going forward as well. Infrastructure is one such theme, and it has many elements to it. One could play it through different sectors, whether it is power, whether it is railways, etc. And as Abhisar also mentioned, there are various ways to play the infrastructure theme as well. One could play it through asset owners, one could play it through contractors, through capital goods, through material suppliers. Then, in addition to infrastructure, energy transition is a big theme which is emerging. Travel and tourism, again, there are various sub-segments through which one can play that theme. That is a very interesting theme. And lastly, I would like to mention manufacturing. We believe that manufacturing is undergoing a big transition, and it will continue to do so for the next many, many years to come. And that is a resurgence in which many opportunities will also come in the market to play that theme.
Thanks, Sandeep. Govindji, typically you like almost 50 stock kind of portfolios diversified across a lot of names. There are alternates who will have, let's say, 10, 15, 20 stock portfolios. How would you define your style of investing, growth, value, and any specific themes also that you would like to tap?
Sure. So, good question again, but let me first focus on our strategy on why 50 stocks and why not 10 or 15 stocks kind of thing. So maybe, if I take the liberty that we are the pioneers of 50 stocks, 50 stocks in the PMS space way back 2009. And since then, we have maintained this 50 stocks portfolio ranging from 50 to 55, 60, depending upon our view on the market and risk horizons. So with this, we have been able to generate 3, 4, 5% alpha over the benchmarks over 10 to 15 years, 10 to 14 years period of time. So with 50 stocks, I'm not compromising on the alpha generation or the risk or the reward which is there. But with 50 stocks, you will agree with me and all others would agree with me, the risk attached to all this 50 stock is far lower than a portfolio which has got 10 or 15 stocks kind of thing. So on a risk adjusted basis, we have been delivering that kind of alpha, and which is recognized by external agencies like you people have got. I am Ahmedabad team and professor who have analyzed the data in last 4 years. They have recognized our performance on 10-year risk adjusted basis. So why do we play this 50 stocks? What is the underlying theme behind it? First is as we all know, Benjamin Graham, many decades back has said that investment management is nothing but risk management. So if we are able to manage our risk well, then return generation will not be that difficult. And that was the thought process right from day one. So what we do, we say that if I if I have a 10 stock portfolio, now in a world which is very, very volatile, in a world where any country and every country has corporate governance issues, whether you talk the best of the names like Volkswagen or Purdue Pharma or Wells Fargo in the US, or here in our country, like you have Dr. Reddy's and Sun Pharmas or Infosys of the world. I'm giving the best names. I'm not talking about very small and mid-sized names. You take whether Germany or you take Japan, anywhere in the world, the number of corporate governance issue cases have been only rising. While every fund manager tries to put his or her best in terms of doing the due diligence on the company, yet we cannot say 100% sure, yeah, this company will not have any issue. So those, I'm sure people know about 2 years back, one pharma company in US, Purdue Pharma, McKinsey, for the first time in the history of McKinsey, they are fined $500 million. McKinsey, which is number one consultant in the world, the countries, consult the McKinsey, right? Whom will you trust? So we believe that while we do our best, we do not have the capability to be 100% sure. Better to diversify across sectors, across market caps, across managements, across businesses. So that is the underlying theme as far as the CG is concerned. Second, we all know how technology is disrupting the businesses. This is despite the management is having a best of the quality and best of the governance. Let me give you a couple of examples. Nokia and BlackBerry, we all have used, 10, 20 years back. They were the global leaders. What happened? Both companies became bankrupt. If you see in US, Amazon has made many established businesses as bankrupt. It's all technology, right? And we know how fast it is creating disruptions across different sectors, whether it is autos, EVs, or now even energy also, So that is second. And because of all these changes, because of the changes in the consumer taste and preferences, the business cycles are getting shorter and shorter. So we believe that the with all the resources what we have, whether we are there or even if you have a team of 30-40 analysts, it is practically impossible for anyone to say yes 100% my portfolio is foolproof. And that is the reason we say that diversification is very, very important. And with that diversification, we are not compromising on the alpha generation. So that is why we believe that the diversified portfolios are far better from risk adjusted perspective. Moving on to the last part of your question regarding the themes, my friends Abhisar and Sandeep have already mentioned. We are playing a theme. We are very bullish on the capital goods segment, as Sandeep mentioned, that manufacturing is going to pick up. Is a multi-year theme. But we are not playing through this the contractors. We are playing this through the technology companies. Because if you see whether it's a small enterprise or medium enterprise or a mega enterprise, every company, every manufacturing unit has the necessity to reduce its energy costs. Every company enterprise wants to increase the productivity. Every company wants to, decarbonize their, the carbon emissions. Which are the companies positioned for this to give you those solutions? So we are playing this theme, and actually we are playing this theme for last 3 years, and we believe this will only intensify going forward. So the MNC companies which have their parent as their technology as the mode, so that is one which has many stocks in last 3-4 years have become 3, 4, 5x there. So that is one. Second, Abhisar mentioned about the real estate, 100% agree with that. So real estate, if you see housing real estate more particularly, there was 9 years of degrowth which was happening in the housing real estate. And housing, as you know, construction is the second largest employer of the labor after agriculture. And which was pulling down the GDP growth, now that has started to perform. And because of the construction, there are many industries, many sectors which get positively benefited, whether it is tiles or you have the paints, you have the plywoods, you have the wires and cables, you have the sanitary ware, faucets, cement, bricks, the transportation, and so on. But as Abhisar mentioned, there are risks associated with many developers. So we are playing proxy to that developers through, again, many of these companies which are where the balance sheet quality is very, very good. So these are the two very big themes. Then again, one has to tweak the allocation based on the visibility of earnings for the sectors. For example, auto ancillaries, 2 years back, we were just 5% allocation. Now we are 10, 11% allocations, so that is again the agility, what I mentioned some time back. So where we saw that because of the volume growth is increasing, B, because of the lower commodity prices, the RM cost is lower, the margins would increase, which is reflected in the higher earnings for all these companies. So we have played this very well in last 1.5 years there. The moment we see that, yes, the earnings growth is peaking out, we may bring down the exposure there. So this is how we are playing on that. Of course, there are many others, but these are the 3-4 big themes we are playing.
Thanks. Those were very interesting insights. Abhisar, we are short of time, but we'll try to squeeze in a question. A lot of government focus on sectors, let's say defense, infrastructure is something that you mentioned. What are the pockets which can drive earnings? Any quick thoughts on that?
So I think, Arjun, infrastructure sector on a whole for the next 5 to 10 years will obviously see very, very good times, because the government is having the intent as well as it is now having the resources. Whatever collections that you are seeing on the direct, indirect taxes, the extra amount is actually, being intended to be allocated more towards infrastructure. And within infrastructure, government is taking a holistic approach. It is not doing as if it is preferring only one side of things. So just a week or so back, India did the India Energy Week, where Prime Minister spoke about how they want to transition to the new energy regime, whether our demand will keep increasing, but we should have an ideal mix in natural gas. We should also focus on biogas and things like that. So I think within the infra, there will most segments will be, seeing much more bigger private players becoming more prominent. We have always thought about only L&T being there when we talk about infra. But now I think in the next 10 years, much more bigger private champion players will emerge. So that is one space, I think, where you need to be very careful because you're dealing with the government. So you can't take things for granted. But I think the earnings can be driven from there. Uh, as well as, of course, Archan, as we grow our GDP per capita, which is still, less than $2,500 per capita, as we move towards 4,000, 5,000, and eventually $10,000 per capita in say whatever number of years, 5 years, 10 years, I think the consumer related segments will continue to do well and will have their say in the the earnings catch up and earnings play. And there, what we as of now are seeing is that the premiumization trend is very, very strong. The wealth management and the capital markets related plays are also looking like very, very kind of strong plays from a sustainable earnings growth perspective. So yeah, it's exciting times actually. A lot of sectors have a lot of things going for them, a lot of tailwinds. If you little bit zoom out and take a 4 to 5 year, 7 year view, so yeah, that's what I think we are as of now feeling.
Yeah, so the rich man is spending on hotels, on airlines. So we see the rush everywhere.
And
Rapid
this
fire.
is just a 2,500 GDP per capita as of now, Archin. Just imagine, when the GDP per capita catches up, I think these trends will only get stronger.
So I think in summary, from all the discussions, end of the day in Indian equities, we'll make money. Right? Where will the risk emerge? We'll do a quick rapid fire because I think we are out of time. Maybe we'll start with Sandeep. Sandeep, we have political events lined up during the year. However, we are backed with strong flows. Where would risk emerge in the markets in the near term, probably medium term?
So in our view, Archan, most of the risks today are, global in nature. Obviously, nobody can call out elections. So that event for India is there. Markets might have taken a view on that already, based on whatever state election results have been there and, whatever developments are taking place in the domestic political scene. But obviously, that remains a domestic risk. Other than that, we believe that most of the significant and key risks are more from a global perspective rather than a domestic perspective. Globally, obviously, we have these geopolitical events, which we really do not know how they could ultimately shape out and how long could they take to resolve themselves. That is one. The second big risk, in our view, could be the fact that we have had an elevated interest rate environment for a long period of time now. Could that have created damages in various parts of the global economy and in specific segments, like what we saw happened with some regional US banks in the early part of last year? And could that manifest itself during this year or later? That is a potentiality. But honestly speaking, to all these risks, we would have to be reactive in nature. Like we saw that whatever happened to the regional US banks in the first quarter of last year, the regulatory authorities over there kind of managed the situation really well. And you actually saw markets, even Indian markets, bottoming out in late March 23. Yeah, so from our perspective, these would be the key risks.
Thanks, Sandeep. Govindji, if you have any quick views on this.
Yeah, sure. So largely what Sandeep has said, I agree. For domestic, I would say it is like a cricket T20 match till the last ball is over. One should not assume that victory is already there in our lap. So that is one. Second, globally, I will just expand what Sandeep mentioned about the interest rate. If you look at the inflation, while inflation, particularly say in US, it's down to 3% from 9.5%. But if you see the ingredients of CPI, while they have, many of them have bottomed out, and now we are talking about global growth again picking up. It's going to be better than last year, and maybe 25 could be even better than this, So if you have the underlying ingredients where they start moving up, oil prices start to move up again. The wages in US are growing at 4.5%. The unemployment rate continues to be many decades low. So the inflation, instead of coming down further, which is 2% target for Fed Reserve, can remain elevated at 3-4% or so average, which again means elevated interest rates in the US, and some of these segments can again get impacted. So that is the risk I see. Geopolitical, again, no one knows. We saw two incidents in last 2 years, but fortunately they have become a lot more localized instead of getting spread. But from India perspective, if you see, the government and the central bank both have managed, say, the both interest rates and inflation relatively much better than what it used to be, and which has led to a lot of stability both at macro level as well as the micro levels and the capital markets. So apart from this, I do not see any major risk there, but one needs to be mindful of these developments which are happening there.
Thanks for that. Abhisar, any final thoughts on risk? Anything to add beyond what
Yeah,
Govind and Sandeep said?
Yeah, of course. I think the risks are very, very well covered by both Sandeep and Govindji. But quickly, just expanding on Sandeep's point, see, look, we are definitely going to remain in a little bit of a higher interest rate regime, Archan. And while market participants get excited, as soon as the interest rates peak out, like they got excited 2 months back, Fed has been trying to kind of say that they will be very data driven. Okay, and so see, as Sandeep mentioned, when interest rates remain high, I think one problem which is still not got solved from the last 10-15 years of excessive liquidity which came into the market is that the debt to GDP still remains quite high across most economies. Okay, and that debt needs servicing. So see, the markets will remain vulnerable for some accidents which may emerge from there because you are in a higher interest rate regime. If you're not able to service the debt and some, unexpected black swan appears. As of now, I think the market is kind of, very confident nothing will come out. And whatever comes out, like Sandeep was saying, regional banks issue came out, it was kind of well managed. So market is taking that call, whatever comes, it will get managed. Okay, so something may come from global market perspective. Other than, of course, the oil being always a risk for India, so the oil correcting from 100, 105 in the middle of the last year to now around 80 odd has been a big boon. And that is, I think, driven some bit of our rally. If it were to go again, for any reason, it can be a negative. And lastly, from an India perspective, I think the risk that we may run now with maybe, this government repeating and coming back with a very strong majority is that they should continue with the reform path, which are the difficult reforms they should take up and not become socialist in nature. See, we always take things for granted. So we will assume that, look, if they have been doing so painful reforms and they have been bold enough to take DMON and GST and everything, they will continue. But I hope that continues and the fiscal deficit is being the primary kind of objective also. And the socialist measures are kept in check because you never know, in a 140 crore kind of a population, a majority government can take such steps which can little bit derail the story. But overall, remain very optimistic, as such, Arjun.
Thanks. I think Govindji wants to add something.
Yeah, I want to, just dwell on that, what Abhishek mentioned about the oil prices as a risk. My view is a little different. If we analyze what has happened in 10 years' time, the petroleum products consumption intensity relative to GDP growth, if you see, has come down drastically in last 10 years. Why this has happened? If you see the measures from the government, our renewable capacity has gone up 4x in last 10 years. Right? Ethanol blending, which was 1% 10 years back, is 11 to 12% now. The railways, which was 6% electrified, they are 42% electrified now. And we have got so many thousands of kilometers of new highways and expressways. So all this, and of course, I'm not talking about biogas and all other things, So all this, if you see, has led to the petroleum products consumption relative to GDP growth has come down drastically. And this is because of all these measures. Earlier, we used to be very, very, worried about oil prices, but market to my mind, correct me if I'm wrong, Abhisar, there's not talking about so much of the oil prices, you know. So that's when we talk about macro stability, this is one such big factor kind of thing. So that is why
Markets have their way to give opportunities and show volatility. We have forgotten what is volatility for the last 6 months. At some point, markets will give us some stories in terms of what risks that are there. But each time over the last many years that we have seen in the markets, risk emerge. If interest rates go up, markets correct. Our view would be interest rates should come down. We are positive. If crude prices go beyond $100, they will come back to, let's say, $60-$80. We will be positive. And so every shock that we see in the markets have been great opportunities to play the India story over the medium to long term. But thank you all for all the perspectives and insights that you have provided. Thanks, Abhisar, Govindji, Sandeep. Thank you and congratulations to PMS AIF World for one more successful event. And thank you all viewers for sparing your time to listening to us. Thank you so much. Handing it back to Aishwarya.